We are going to focus heavily on the Ponzi scheme clawback. I'm going to go through an outline first so that we can see how all of this fits together before we start looking at its separate pieces. The Ponzi scheme clawback is for those who may have benefited from the Ponzi scheme and then must pay back funds to the Ponzi scheme trustee, often years later, after the Ponzi scheme has collapsed. Sometimes it's a payback of profits. Sometimes it's a payback of both profits and principal that was paid back. We cannot consider the taxation of the Ponzi scheme clawback without an initial reference on how direct Ponzi scheme tax theft losses are dealt with for U.S. tax purposes. That'll be the first part of the outline. This is because there is a special code section that allows people who have reported profits from a Ponzi scheme that were clawed back and paid in later years to have the advantage of excluding their clawed back payments, profits only, not their clawback of principal. But they may exclude their clawed back payments in later years from taxation in the earlier years when those funds were actually taxed, often in higher tax brackets. This is a special advantage because often the statute of limitations has run, and people who are paying back clawbacks cannot go back to the earlier years where the tax bracket may have been higher and take advantage of the fact that they paid higher taxes in those years, and they should recover the taxes paid at those higher brackets. This special code section, called the mitigation section, allows just that to happen. It's a unique tax benefit, and it permits the exclusion of Ponzi scheme profits from income in the years they were earned if those funds are paid as part of a clawback. After studying the Ponzi scheme direct theft loss, we're going to study the 5 requirements that are necessary to use this unique tax situation, the mitigation section. The taxation of clawbacks is different because the taxation of direct losses, if there is a clawback of principal, is treated the same way that the loss of principal in the original Ponzi scheme is treated. And we're going to review that. It is the clawback of profits only that get the unique treatment of being excluded from the years that they were earned in if the overall effect of that exclusion is a better tax refund situation than merely deducting those clawed back monies from the year in which they are paid. Let's assume that an investor has invested $3 million in a Ponzi scheme and also received another $3 million in taxable profits, and received all $6 million as cash payment before the collapse of the Ponzi scheme. Let's assume that the trustee now claws back $4 million from that investor. It will make a world of difference on how this $4 million is treated. The investor typically will want to treat $3 million of this as a clawback of his profits, his or her profits, and only $1 million as a clawback of his or her principal. This is because of the advantages that are offered to the clawback of profits. Because this subject is complex, we're going to walk through the outline so that all of this can be pulled together as a whole, and then we will look at each one of the separate parts that will help define the tax treatment of the clawback. First, we will study the direct Ponzi scheme losses. We'll look at the definition of theft, which is the code section under which direct Ponzi scheme losses are taken. We'll look at the character of the deduction, which is an ordinary loss deduction. And we'll look at the way carrybacks and carry-forwards of those deductions can be taken for maximum advantage. Next, we'll look at the clawbacks. First, we'll look at a comparative chart to show how many different ways the clawback can be used so that it can be maximized either by excluding profits, by deducting profits from taxable income, and by carrying losses back and carrying losses forward under certain different circumstances. In looking at the clawback, we're going to study the 5 requirements that one must meet so that they can take advantage of this clawback mitigation section. These advantages are placed in the code because the mitigation, or the right to go backwards even though the statute of limitations has closed, is a very special tax benefit. And the IRS does not want people to benefit from this section unless they fit certain particular criteria. We will look at the entitlement to the deduction and the fact that the deduction must be highly related to the initial inclusion of the income and of a similar type. And we will then look at the fact that the clawback of principal does not benefit from the mitigation section. A clawback of principal is not permitted to be taken back in those years when the principal was first invested. It is only a clawback of profits that can accomplish this. The clawback of principal is going to be treated exactly like the clawback of Ponzi scheme original losses, which we discussed. Losses that are deducted in the year that they are claimed and have their own unique tax treatment. Finally, we will summarize all of these and review these charts again so that it will become completely clear why and how one can take the most advantage of the clawback.